Welcome to enrichminds.com and to our session on commodities. We have so far discussed various asset classes like equities, bonds, mutual funds, and ETFs in earlier sessions, and today we shall discuss commodities. In this session, we shall learn about commodities as an asset class and how they can be traded. Commodities are raw materials. They are the inputs or ingredients that are used to make most of the stuff in our lives, from the cotton in your shirt, to the aluminum in your car, to the coffee in your mug. Commodities are defined by two main properties. First, they are uniform in quality. There is no difference in a commodity, no matter who produces it. For example, whether petroleum is extracted from Saudi Arabia or from Iran, it is pretty much the same. Hence, petroleum is a commodity. Second, many different companies produce and sell them. There is no company that has complete domination or control over the production of a commodity. Commodities are not branded products, unlike, say, Coca-Cola or a Mercedes-Benz. The first characteristic helps explain why finished products, such as cars or clothing, are not commodities. For investors, commodities can be an important way to diversify their portfolios beyond traditional securities. In the most basic sense, commodities are known to be risky investment propositions because their market, as determined by supply and demand, is impacted by uncertainties that are difficult or impossible to predict, such as unusual weather patterns, epidemics, and disasters, both natural and human-made. There are multiple ways to invest in commodities, such as futures contracts, options, and exchange-traded funds or ETFs. Commodities are a very high-risk and speculative asset class and should be considered only if one is a real commodities expert. It can be highly speculative and risky, and it is an asset class that should be left to experts. There are four major categories of commodities, and they are: first, agriculture. For example, corn, wheat, soybeans, coffee, cotton, and rice. These are naturally produced from the earth. Second, livestock. For example, cattle or pork. These are mostly animals and meat. Third, energy products like crude oil, natural gas, gasoline, coal, and heating oil. These are mostly extracted liquids from below the Earth's core that are used for production of energy or used as fuels. Coal is the only exception of being a solid extraction used in generation of power and electricity. And finally, fourth, metals like gold, copper, aluminum, and other rare minerals, etc. These are mostly solids mined from below the Earth's surface. Another way of looking at commodities is based on their type. Soft commodities are agricultural products and livestock such as cows, wheat, sugar, and soybeans. These tend to either rot or die over time. Hard commodities are those that are mined or extracted from the earth. These tend to be storable and can be kept for long periods of time. Commodities can be bought and sold on an exchange similar to stocks. In the United States, most of that trading happens at the Chicago Board of Trade or the New York Mercantile Exchange. There are two main ways of trading commodities in these markets. First, the spot market or cash market. Here, the transaction happens immediately. For example, if you agree to buy gold in the spot market, you put up the cash right away, and the seller has to immediately deliver the physical gold to you. The actual so-called settlement of these transactions may take a couple of days. Second, the futures market, where participants agree on a price for a future date. Here, you agree today to make a transaction on a future date. For example, you can agree today to buy 1 ounce of gold in 3 months at a particular price. When the agreed upon date of your transaction rolls around, you have to pay the price you agreed to at the start, even if gold is now cheaper. And the seller has to accept that price, even if gold is now more expensive. The futures market is not only used by investors, and is actually also often used by commodity producers to help reduce risk. If an oil company knows it will need to sell 50 million barrels of oil in 2 months, it could enter into a futures contract today to lock in a sales price for all that oil. That way, it is protected if the price of oil takes a sudden fall right before it has to sell. Commodity prices can be much more volatile than stocks. Institutions, farmers, and professional investors tend to be bigger players in the market than individual investors. Let's watch a short video courtesy of Capital.com.
Commodities are a part of our everyday lives. Traditional commodities are the raw materials we put into other products we use in practically every area of our lives without a second thought. The more traditional commodities fit broadly into the areas of agriculture, energy, livestock, and metals. In the mornings when we get up and get dressed, we may use the commodity of cotton when we pull on our t-shirts, or the commodity of gold and silver when we dress in our jewelry. At breakfast, we consume the commodities of oats, wheat, coffee, and sugar through the products that we buy. And we cook breakfast using the natural gas piped into our home through our energy supplier. Mum and Dad Carter are sophisticated long-term investors in equities and bonds. They've been mulling over adding commodities to their portfolio to enhance their returns and to smooth out volatility in their portfolio. Mum and Dad Carter can invest in commodities in a number of ways. They can invest directly, but that limits them to materials they can physically store, or they could trade in commodities through future contracts. This gives an investor with the right know-how exposure to commodity prices through the futures markets. Futures contracts are financial contracts that buy specific quantities of a commodity at a specific price and delivered at a specific date in the future. These financial contracts fall into the derivatives category and are obligations to buy the underlying asset. The prices of these contracts are based on the underlying commodities and are often used by speculators who believe the commodity price will move in a specific direction. Small movements can result in very big gains or losses. There are many risks that can make your investment go wrong. Mum and Dad Carter, while confident in their investing abilities, thinks it all sounds a bit complex and risky. The other option our investing duo can consider to gain greater profit that doesn't require them to purchase underlying assets is another derivative instrument called CFD trading, which means contract for difference. This is essentially an agreement between two parties to exchange the differences between the opening and closing price of a contract. CFDs allow Mum and Dad to use leverage. This is added flexibility because they must only pay a fraction of the total value up front. So while they have the opportunity to maximize their gains, equally, they can also have greater losses than the amount they put in initially. Plus, Mum and Dad should take into consideration not only the interest charged daily, but also any commission and financing charges for transactions from the broker. They don't have to do the high-stakes game of the futures market. They could, for example, buy shares in companies that are engaged in producing and extracting commodities such as oil companies, cereal manufacturers, or mining. Another option is to leave it to the professionals through the diversity of a pooled investment club that manages trading in futures on behalf of its members for a fee. They could also use the exchange-traded funds, or mutual funds, that follow one or more commodity. The fund manager of these funds allocates funds into each commodity and buys future contracts. This may seem dull, but for the Carters, it means more time spent with the kids.
In summary, Both novice and experienced traders have a variety of different options for investing in financial instruments that give them access to the commodity markets. First, while commodity futures provide the most direct way to participate in the price movements of the industry, there are additional types of investments with less risk that also provide sufficient opportunities for commodities exposure. Second, in the most basic sense, commodities are known to be a very risky investment proposition because they can be affected by uncertainties that are difficult, if not impossible, to predict, such as unusual weather patterns, epidemics, and disasters, both natural and human-made. And so, rather than invest directly in commodities speculatively, one could consider investing in ETFs or stocks in companies dealing with commodities instead. Thank you for your time, and until next time then, stay enriched and strong.